Did President Cyril Ramaphosa tell the truth when he claimed the World Bank doesn't blame Black Economic Empowerment, or BEE, for South Africa's slow economic growth? Let's fact-check this. I'm Rebecca Davis, senior journalist for Daily Maverick. At the end of May in Parliament, Ramaphosa had a fairly grumpy exchange with Freedom Front Plus leader Corne Mulder, who suggested Ramaphosa should be open to rethinking policies like BEE.
And to have you, sir, saying Black economic empowerment is holding our economy back goes completely against even what the World Bank says.
Ramaphosa insisted that it wasn't BEE, but rather concentrated ownership of the economy that's to blame for slow economic growth. And he claimed that both the World Bank and the IMF agree.
Is that, and a few years ago, the World Bank and the IMF came up with a report that one of the things that holds South Africa's economy back from growth is the level of concentration. Concentration because they said the ownership of the economy is in far too few hands. Ownership has not spread. That is what the World Bank and IMF said.
But is that really what the reports say? Let's break it down. Ramaphosa didn't say which reports he meant, but both the World Bank and the IMF released fresh reports on South Africa in early 2025. The IMF's South Africa Country Report was launched in January, and the World Bank's Driving Inclusive Growth Report landed in February. So let's start with the IMF. What did that report say about BEE? Well, literally nothing. The IMF report does not mention BEE or employment equity or affirmative action. But it does highlight deep racial inequalities in income. So while the IMF report supported the idea of reducing inequality, it didn't weigh in directly on whether BEE is helping or hurting the economy. What about the World Bank? Well, this is where things get a bit complicated for Ramaphosa. The World Bank did mention BEE, and not entirely favorably. It flagged BEE as a market distortion. One, it says, that has still not been fully evaluated for effectiveness. But to be fair, the report still didn't call for BEE to be scrapped. Instead, it recommended easing the burden on foreign investors, suggesting they use equity equivalence investment programs like training Black workers or partnering with local Black-owned firms as an alternative to direct ownership requirements. In other words, handing over ownership of a percentage of your business to locals. It also noted that the government has offered these alternatives since 2021 in sectors like IT and banking. The World Bank did say that the government should also speed up the digitization of the procurement system, in other words, tenders, to improve transparency and automation. The IMF also stated that reforms were necessary to the procurement system to cut down on corruption. The thing that Ramaphosa did get right is that both reports do say that South Africa's economy suffers from high market concentration. In other words, too few big players dominate key sectors like banking and manufacturing. So here's the bottom line. Yes, both the IMF and World Bank see concentrated ownership as a problem for South Africa's economy. No, the World Bank did not give BEE a clean bill of health. It raised concerns about how it might deter foreign investment. Ramaphosa's claim that these international financial instruments don't see BEE as to blame for South Africa's economic growth at all is a half-truth. But so is the claim that you'll see on social media that the World Bank and the IMF have identified BEE as the main obstacle to growth.